everyone, and welcome to this month's Title Now pop-up webinar. I'm Melissa Murphy with the fund, and I get the pleasure and fun of hosting these pop-up webinars on pretty much a monthly basis. While this webinar is being recorded, only the audio is going to be pushed out after the webinar, and it gets pushed out through our our podcast, which is also conveniently called Title Now. And you can subscribe to our podcast anywhere that you subscribe to your other podcasts. So please, we would love to have you as a subscriber to our podcast. And it does make it really easy for you to listen to the information again, and also very easy for you to share with colleagues that you think might be interested. And we do try to focus in these podcasts on very timely topics, perhaps ones that haven't been fully vetted out or figured out yet, but we want you to be aware of them. And I have to say, our regulators just rarely disappoint us. They're always giving us things to talk about. And here we are again with yet another breaking news item to talk about. So let's set the context for what we're going to talk about today. A little background. FinCEN, which is the Financial Crimes Enforcement Network of the Department of Treasury, is pretty dedicated to combating money laundering in the U.S. And they have identified residential real estate as a popular vehicle for a significant amount of suspicious activity by individuals involved in illegal money laundering. And one organization that tracks this type of thing on a worldwide basis has estimated that $2.3 billion was laundered through U.S. real estate transactions between 2015 and 2020. So in 2016, FinCEN began their process of collecting information about real estate transactions through a series of geographic targeting orders, which we refer to as GTOs. And those GTOs required the reporting of certain types of cash transactions on residential property. And they were limited geographically, geographic targeting order. But with time, the GTOs were renewed and expanded. For example, in Florida, the initial GTO only covered Miami-Dade County, and there was a $1 million price threshold before the transaction must be reported. But now the GTOs cover 11 counties in Florida and require the reporting of information on cash closings of residential property where the price is $300,000 or more and the buyer is an entity. Trusts are not included currently under the GTO, nor is vacant land included. Well, apparently the data that FinCEN has been receiving nationwide from the GTOs has been effective in their eyes at identifying suspicious individuals in roughly 40% of the transactions reported. Now that's nationwide, not just in Florida. FinCEN thinks this is a pretty good batting average, so they've decided they want more data. And they have proposed a rule that would take the reporting requirement nationwide. They have done away with a dollar amount threshold. So gratuitous transfers are also covered if the rule is not refined. So $10,000 vacant lot sale, that is covered. Lastly, trusts are now covered by the rules. So these are pretty significant expansions and will have a big impact on the real estate industry. So we're going to talk, time permitting, about the details of the proposed rule and how it might affect fund members. And a couple of housekeeping things. My guest and I, Melissa, everybody knows Melissa, but my guest and I will be using the terms buyer and seller along with the terms transferor and transferee. The rule says transferor and transferee, but it's just easier for us to use the terms buyer and seller because it's going to affect you most often in those traditional purchase and sale transactions. But many of our comments are not limited to those more traditional purchase and sale transactions, because remember, apparently gratuitous transfers must be reported under the rule in its current iteration. Last housekeeping item is put your questions in the questions box over in the panel that's on the right-hand side of your screen. We probably would not have time to respond to all of your questions during this short webinar, but we will get a copy of those questions after the webinar, and we will do our best to respond to all of you with any questions. So with me today is Melissa Scaletta. Melissa's our Deputy General Counsel at the fund, and we are both pretty involved in learning about this proposed rule, thinking through how members could incorporate compliance into their work lives, and all of the other aspects of this rule as best we can. So welcome, Melissa. Thanks for joining me today.
Thank you.
So let's begin with the types of transactions that are covered by this rule. Melissa?
Okay, well, first, thankfully, there are some limited exceptions where you do not have to report under the proposed rule. They include transactions involving easements, transactions resulting from the death of an owner of residential property, transfers incident to divorce, and bankruptcy. But if the transaction doesn't clearly fall into one of those exemptions, then you have to further consider, are you dealing with a cash transaction or transfer of residential property to an entity? And that's not as simple as it sounds. You have to further break down what does the proposed rule define as cash, as residential property, and as a grantee entity.
So let's start with cash. How does FinCEN define cash?
Okay, well, of course, traditional cash is cash. So if you have a true cash transaction, we're in that area. But some financing transactions or financed transactions also qualify as cash. An institutionally financed loan is not considered a cash transaction. But when you have a non-institutional lender, like a hard money lender, this would likely be considered a cash transaction because generally those types of lenders don't have anti-money laundering obligations and policies. And that's really what it's all about. If there is no such policy, anti-money laundering policy, then it's a cash transaction.
So any guidance for members as to how they confirm whether a lender is one that has those anti-money laundering policies and obligations that would pull that transaction out of the coverage of the rule?
If you're dealing with a non-institutional lender, it probably is best to ask at that point. If you're dealing with an individual,
clearly,
yeah, you're going to have to report.
So the next factor is what's meant by residential property. How does FinCEN approach that?
Okay, so again, this is a little different as you mentioned. Clearly, if you have a 1 to 4 family occupancy structure, that's residential. But vacant lands that's either zoned as or a permit's been issued for 1 to 4 family housing is also residential, and shares in cooperative housing corporations are considered residential as well.
This is so perplexing to me and worrisome to me. How will a settlement agent know whether the vacant land that's covered by this contract is zoned residential for that type of use?
You know, it's a real issue because often the role the title agent plays with a vacant land sale transaction would not include inquiry for that kind of information. So as you can imagine, this has been a really hot topic in the industry groups that we've been involved in as we develop commentary to deliver to FinCEN on the proposed rule.
Well, that will definitely be an area that will need to be addressed in some way. All right, so we've got what's cash, what's residential. Now we get to the transferee entities that are covered by the rule. So help us out there.
Okay, so transfer entity is defined as any non-individual or trust, right? So what does that mean? Any kind of entity at all, LLC, a corporation, a partnership, any type of entity that is created. Except there is a list within the proposed rule of certain entities, it's pretty lengthy, that are exempt. And we would categorize these as the type of entities where either the government already has knowledge of the ownership, or also those that are known to have anti-money laundering procedures, like certain banks and credit unions, public utilities, insurers, things like that. Non-for-profits, though, are not accepted. And then we have to look at all kinds of trusts as transferees. And the only exception for a trust to the reporting is a statutory trust. Now, I'm not sure I've seen a statutory trust in all of my years in the title insurance industry. What we see very often is variations of revocable and irrevocable trusts, and those do fall within this entity definition requiring reporting.
So pretty much any kind of trust is going to be a transferee that will trigger the reporting requirement, and any of the standard normal entities like those LLCs and corporations that you mentioned. So the big change here is the addition of trusts being covered. So this is a lot so far, and we haven't even gotten halfway into this, Melissa. So we've covered what types of transactions are covered by the rule: cash, residential, entity, buyer. Now let's move into what could be the hairiest part of this rule, and that's the type of information that will need to be reported. Where do we start?
Okay, well, first let me say, this is a really high-level overview. We're not going to go into detail here because there is so much detail, but this amount of information required greatly exceeds both the amounts of information that was required under the existing GTOs and also likely go well beyond the information that you normally collect for your closings today. So some of the newest information that was not previously required includes dates of birth and citizenship. Information about the transaction itself have to be reported: the price, the legal description, the date of closing. That's not hard to ascertain, but some of your legal descriptions will be difficult to enter if you have a lengthy means and bounds description. The information that has to be collected will pertain to the grantor, which is new. Under the GTOs, they didn't make you collect detailed information about the grantor, but also entities and trusts as transferees and certain beneficiaries of each of those, and the reporting person. And essentially, when all these details are gathered, what the proposed rule is seeking is that you eventually, as the reporting person, get down to the individuals and report the information on the individuals that are behind these entities. So,
yeah, I was going to say, the goal, I believe, of this rule is to drill down till you get to a flesh and blood person, whether it's a trust that you're dealing with or an LLC or a corporation. And the level of detail that's required once you get to that flesh and blood person is more than what you might logically and with common sense assume is needed. So there is a lot that has to be unpacked in this part of the rule, and is one that you're going to have to read over and over and over and get it straight in your mind, because it's not something you read once and go, okay, I've got this. It's going to be challenging, and we'll see what comes out of the wash when FinCEN proposes the final rule. But I agree. There is a lot of information here that's required that one might not normally think you would need to collect.
And we'll provide lots of resources when we have a final rule to make sure that everyone is prepared to collect the information. I also want to mention, Melissa, we are used to collecting things, or we're used to collecting information related to addresses, right? And taxpayer identification numbers. But it goes a little further in that regard. When you don't have a taxpayer identification number or a foreign one, you have to collect passport numbers. And then another aspect that's new is more detail on specific payments that are made in that transfer from any party other than the transferee. So when payments are made by any party other than the transferee, okay, you have to report the amount and the method of payment and the name of the financial institution. That's not so bad. You have to report the account number the payment was paid from and the name of the payer. And we understand that very often when wires are dealt with, that information is not readily available.
Well, it's my experience that when the settlement agent gets a confirmation from their bank that money was wired into the settlement agent's account, what they are sent is a confirmation that tells you, okay, John Smith sent money from Wells Fargo for this closing. Usually there's a reference to which closing it is because John Smith may not be the transferee buyer, and the amount. But it doesn't tell me John Smith's account number at Wells Fargo. So how is the industry going to deal with the fact that the banks aren't obligated by this rule to provide that information, but the settlement agent is required to provide it to FinCEN? So we'll talk about some of those challenges in a minute. But this would include things like the real estate broker sending the deposit. Yes?
Yes. Any payment by a party other than the transferee, which I think that is the most common one you've touched on, the earnest money deposit.
Yeah. So this sounds like a tremendous amount of information that is going to have to be collected by the settlement agent, asked for and requested of the generally the transferee buyer and the principal, not the principals, the beneficial owners. So what thoughts have you had about the challenges that members are going to face in collecting this or dealing with it?
Time is going to be a huge one, of course, but going beyond that, figuring out how you're going to collect all the information you need, dealing with a transferee who is refusing to provide the information that you need. Something that we've considered is that very often we see contracts where the transferee is an individual, and in the 11th hour, the contract is assigned to a trustee of a trust or an entity. So then that's suddenly going to make that reporting person have to start digging for the information that they didn't know they were going to need. They didn't know they were going to report. So there's going to have to be a lot of thought placed into how much lead time is needed to collect this information in order to be ready to close on time. Now, reporting is required to occur within 30 days after closing. So if one were to get themselves into a situation where they close without all the information, then they would be at risk that they weren't able to get the necessary information in time to make a timely report.
Yeah, I can just hear that transferee individual that calls and says, my CPA tells me I need to put title to this property in an LLC. So I formed a new LLC. I just sent the documents off to Tallahassee today. And then that triggers the settlement agent having to collect all this information. And what if the transferee buyer doesn't have that handy, or is out of pocket, or isn't communicating? And so are you going to run the risk of relying on them to give you that information after the closing? So is any of this addressed in the rule? Does FinCEN account for these challenges that the reporting person is going to have?
No. I mean, there's estimates of time that this will all take, and they're significant and they're expensive, but we're concerned that it's not possible to know exactly how long this will take and how achievable this will be. So it's all been part of the discussions we've been having within our industry groups, the real property section of the Florida Bar, ALTA, FLTA, in preparing our commentary. It's been a huge area for discussion with regard to commentary.
And these things that you and I are talking about are similar to concerns that are expressed by potential reporting persons, let's just say title agents across the country. And so these groups that you mentioned, American Land Title Association, Florida Land Title Association, Real Property, Probate, and Trust Law section of the Florida Bar, we're all thinking about this and considering whether to make comments that we'll talk more about in a minute, how those comments fit into this regulatory procedure. But I'm hoping that the ABA might weigh in and some of the other legal industry groups. But yet another factor for fund members to consider is who in your office is going to be responsible for this, which leads us to touch on who is obligated to do the reporting under the proposed rule. And I understand that FinCEN has created what they call a cascade of people that are considered reporting persons and required to report under the rule. So how does that work?
Okay, so remember under the GTOs, those were issued to the underwriters and applied to the underwriters and the agents. So it was clear how the reporting was going to occur. But you're right, under this rule, there is a creation of a cascade with regard to responsibility of reporting persons. The cascade is also referred to as a waterfall. And it's essentially a prioritized list of the party obligated to report in each transaction. And here's how it works. So first up for reporting is the party listed on a settlement statement as the settlement agents. If there is one, that's who's obligated. But if there is not a person listed as the settlement agent, then it's the person who prepared the closing statements. Now, remember, this proposed rule also applies to non-consideration transfers. So we don't stop there. There will not always be a closing statement. So if we don't have either of the first two, then the person who files the deed with recording office is required. Next, if there's none of those, the underwriter of any title insurance policy that might have been issued is required to do the reporting. There may be none of those. It may be an uninsured transaction. Remember, the GTOs were limited to insured transactions. This proposed rule is not limited to insured transactions. So if we have none of those prior parties that I mentioned, then the person who disperses the greatest amount of the funds is obligated. If there is still none, because remember, consideration-free transactions are applicable, then the person who provided an evaluation of the status of title is required to report. There still might not be one of those people. And this is where I think of estate planning deeds that I see all the time that are done without the benefit of title examination. The final person listed or category listed is the person who prepared the deed who is required to report. The rule goes further, though, to talk about something called a designation agreement. So the reporting person may agree with another reporting person within the cascade to designate that other person on a per transaction basis to report. If this occurs, the designation agreement has to be in writing, and it has to contain some very transaction specific details. It seems to me that the requirements of a designation agreement, the way the proposed rule is currently written, is very tedious in that it has to have all these very specific details about each transaction.
It doesn't seem to be particularly workable if it's only pertains to one transaction. So another area for comment to FinCEN. So have we covered the substantive points? I think so. Let's mention, though, a couple of other things in our remaining moments. What about how much trouble can I get in if I don't comply?
Okay.
What are the penalties?
So the penalties for noncompliance are substantial. They include criminal liability and civil liability. So there can be fines. Again, they're substantial, and the extent of them really depends upon the severity, whether the violations were willful or negligent. There's also liability available for structuring transactions to avoid reporting. There's also the potential for prison time.
Yeah. Okay. So we have to take this kind of thing very seriously. Certainly, the federal government takes money laundering very seriously, and I can't argue with that. I can't argue with that. We've just got to figure out a reasonable way to help the government identify those nefarious people. All right, so we've covered the rule, we've covered the penalties. Remind everybody the status of this rule.
So it's a proposed rule, and we're in an open commentary period. And the commentary period, the final day is April 16th. When you review the proposed rule, which is within the Code of Federal Regulation, it actually provides for how you could make comments. As Melissa and I have discussed, a few of the industry groups we're involved in we're actually working on comments on behalf of those groups, but individuals can make comments as well. We understand that in the rulemaking process, FinCEN is obligated to consider and respond to every comment. So as Melissa Murphy says, we're going to expect there will be a go dark period when the commentary period ends, because they'll have to diligently work to analyze the comments. Then once a final rule is published, it is expected to go into effect 1 year after that point. And Melissa, the estimate that I've heard is that we think we'll probably have a final rule beginning of 2025 to be effective beginning of 2026. Is that correct?
That's what the folks at the American Land Title Association that are really on top of this and have worked with FinCEN before, that's their guess as to FinCEN's normal turnaround time. They're going to get massive amounts of comments on this rule by April 16th. And as Melissa already alluded to, FinCEN is obligated to look at every single one of those comments and respond to it. They can group them together if they're similar comments, but they are obligated to respond to each of those comments in what I would call their executive summary that will go along with the final rule. And they just think it's going to take until the end of the year, maybe even January of 2025. And their reasoned expectation is that FinCEN will give the industry a year to get ready for this rule. So cross your fingers about that. So we're talking a lot right now about what this proposed rule contains. And we're doing that just to make you aware of what is coming, because a rule will pass that will require reporting, a lot more reporting than you are used to, because many of you listening today aren't covered by GTOs and you haven't done this at all. So there will be a rule that will impose an obligation on you in some way, shape, or form. So we wanted to make you aware of it, but as I'm apt to say, things will go dark for about 6 months, and you won't hear anything about this until they come out with the final rule. And then, of course, we will get into high gear to get you ready to incorporate this into your workflow. So I want to thank everybody for attending today and listening. A reminder that we will push the audio from today's webinar out on the podcast, which is also called Title Now. So please subscribe to that and share this information with others that would be interested in it. And if you think of a topic that you would like for us to cover in a pop-up webinar, these quick 30-minute free webinars, shoot me an email and let me know that there's a topic you think would be great and there would be a wide audience for that. I would love to hear from you. Thank you, Melissa, for helping me with this information and with all your work on those various industry groups. Thank you so much. And to those of you listening out there, as always, thank you for your support of the fund. See you next time.